In this video, we review the ROV, CMOL, ALM, or asset liability management pertaining to interest rate and liquidity risk. So again, as usual, start the software, and what we did was clicked on the File menu, in this case, and loaded an example. And in this example, we went to Asset Liability Management, ALM, and under ALM, you see we have interest rate risk and we have liquidity risk. Liquidity risk typically pertains to 1 year, month 1 all the way to month 12, for instance. And interest rate risk typically pertains to a little bit longer time period, so for multiple years and so forth. So let's start with the interest rate risk. You would start from the left to the right. We start with the input assumptions. You start with settings. In this example, we just put in or entered in the bank's regulatory capital, number of trading days per year, typically 250 to 252, the local currency name, whether it's dollars, pesos, renminbi, and so forth, and the analysis for that month, this time period. Typically, Basel II, Basel III requires you to run the analysis every month, and it's just simple to put in a time period, for example, January 2014. That way we can remember when the analysis was actually run and so forth. You can put up to as many value at risk or VAR levels as you wish. In this example, we just use 3 levels, 99, 95, 90%. Again, up to you as the user to put in as many VAR periods to VAR percentiles to run. The basis point sensitivity for the scenarios and sensitivity analysis, 100 basis points and 200, so 1% plus minus and plus or minus 2%. And also any number of foreign currencies, in this case just 1. And you can save the data set as your own data set. For example, my sample data based on all the settings and so forth, and you click on Save As. But in this example, we'll just use the previously created ALM interest rate example 1. So when you're done with creating all the settings, go to rate sensitive assets and liabilities. And the reason why we have asset and liability here for local and foreign currency 1 is because we said there was only a single local currency and only 1 foreign currency. If you have multiple foreign currencies listed here, you would see additional columns to the right, foreign currency 2, 3, 4, and so forth. Here we have time bands 0 all the way to 12, which represents the various months, and from 13 to 24, which represents year 2. And then notice that it hops on every 12 months, so 36, 48, 60, and so forth as the time band, all the way to time band 360 for 360 months in this case, so 30 years. You can go as far out as you wish, but just be careful of the time band fluctuation after year 2 that it jumps. So input in your or copy paste from Excel, as we saw previously in the previous video. Just select from Excel, copy, and select the location and do a Control V to paste in the data. So we have rate sensitive assets and liabilities. We also have historical interest rates that you can put in. So here are the interest rates. That's all you need to do. And just to make sure that we are comfortable with the methodology of utilizing Excel, so here's an example of some sample data inside Microsoft Excel. So let's say we have some historical data here. We just do a Control C or right click, and we do a copy in this case. And what we do is we come back down to the data set, the location that you want to paste your data in, okay, and select wherever the starting point is and do a Control V to paste the data in. That's all we're doing. So it's interchangeable between flat files, Excel, and so forth. So once you're done with entering all the data, remember to click Save, of course, to save your data and your settings. And that's your input assumptions. Next, you go up to level 3, in this case, the third level of tabs, and you go to gap analysis. And we see the gap analysis for your January 2014. Here we have various time bands going up to 360 months, 30 years. And you see your gap analysis for pesos and for dollars. So you see your foreign currency gap, your cumulative gap, which is a summation of things going forward, and your asset and liability cash flows. You can go to EVE, economic value of equity, and see your bank's regulatory capital and the calculated economic capital interest rate risk for both your peso, your domestic currency, and your foreign currency. In this case, happens to be dollar, and your total value at risk. You can also see your duration gap and plus or minus 100 basis points and 200 basis points, what the deltas are in this case for different scenarios. You can then go to net income margin, and in NIM you would see various cells which are white in color. The white cells are where you would enter in data, and the gray cells are calculated results. So in this case, we have your cumulative cash flows for your 12 months for net income margin. You can put in your interest and financial expenses, and whatever your starting balances, and your 12 months going forward. You can also add in additional, data in this case, and what we'll do is we'll calculate your total liabilities, total assets, and once that's done in your input assumptions, we'll calculate your NIM results, net income margin results, based on the inputs that you have here in the white cells. Remember to keep scrolling downwards because there's additional information to be entered at the bottom, and enter in your NIM results. And there you have your calculated, based on your basis point changes, 50, 100, all the way to say 500 basis points, your NIM for 1, 3, 6, and 12-month period, and your financial margin percentages. So that is your interest rate risk. Then we can also look at liquidity risk under the ALM module. Liquidity risk, you start with, again, your input assumptions. So any cell that is white in color is an input cell. So again, you can copy paste or just enter in the data. Remember to scroll downwards, of course, in this case, because there are additional input cells that's to be entered. On the top section, you see your assets, and the bottom, you see your liabilities. You start with your balances, and then you have your 12 months going forward. So some of these inputs are not applicable. Just leave it empty or enter in 0. It really doesn't matter. Either way will work. And again, you put in some settings, let's say for January 2014, starting month, whatever that month is. Management limit, contingency limits. You can put in your liquidity bonds and loans. So under liquidity, in this case, you see there are 6 subcategories. You can add as many categories as you want by using the item here, increasing or decreasing. Just make sure you remember to hit save or save as, okay, if you're creating a brand new data set, so that you can create as many data sets as you wish, as we had explored previously. And once you're done with this, remember to do a file save or save as on your new profile. Again, that single profile that we save, doing a save as, is the global profile. That single file incorporates all of your data sets, all of your input assumptions, as many data sets, as many models as you want, okay, to be created. So remember to do a global save in this case, so that you can actually resurrect it and play with the data that you've saved going forward. So here we'll use the sample data set that was entered. Again, you can override it, create your own data set as required by clicking on new and typing in or copy pasting. Then you can go to scenario analysis. You can create as many scenarios as you wish. In scenario analysis, we're making changes on assets and liabilities. And here are all the assets and liabilities, subcategories that you can make changes on. For example, available individual firm notes, discounted notes. All these stuff are listed up here. These are your inputs, so available, regulatory, technical notes, and so forth. Discounted notes, mortgages, and so forth. So based on what your inputs are on here, so if you type in ABC here instead of pledges, you would see ABC being resurrected here. So you can do a enter scenario using a percentage change, or enter scenario using actual values. So you're creating a scenario whereby the numerical numbers, okay, these values that you entered here, could be changed as a plus or minus a percentage, or could be changed to an actual value. So from $5 to $7.50, or $5 plus or minus 10%, for example. Typically, we would use a plus or minus percentage change, if you will. So enter in the data that you want changed, as a in this case, plus or minus a percentage for assets, and then for liabilities as well. And you can save those scenarios, as many scenarios as you want. Put in a name that's descriptive, so you know what scenarios we're looking at. Worst case scenario, banking failure, scenario under a global catastrophic events, and so forth. So something that is descriptive, and save it. Same thing for stress testing. For scenario analysis, you're able to change both assets and liabilities by definition of Basel II and Basel III requirements. For stress testing, you are only allowed to change liabilities in this case. So public sector, private sector for time deposits and regular deposits. Again, those percentages could be plus or minus a percentage, or plus or minus an actual dollar amount. The percentages in this case are based on whatever your inputs are on here. Your public sector for liabilities, and public and private sector for time deposits and regular deposits. So create as many stress tests as you wish, and once you're done, save it, and you go to gap analysis, and now you see your gaps for the next 12 months, month 1 to month 12, your current effective gap, different scenarios. If you've created 10 scenarios, you would see 10 rows in here. In this example, we only created 2 scenarios, and therefore you only see 2 rows here. You also see a stress test. In this example, we only created a single stress test that we saved. If you created multiple stress tests, you would see the various stress tests that would be calculated in this case. So individual gaps, cumulative gaps, liquidity indicators, your management contingency, and different limits and so forth based on liquidity indicator analysis, or LIA. You can also click on charts and you would see your current gap, cumulative gap, and liquidity KRI, your key risk indicator, going forward for the next 12 months in this case. That's all there is. It's very, very simple to use. We highly recommend utilizing, to get started, your load example to make sure that you have a sample set of data that you can use to play with